Immigration's hit 75-year lows, and purpose-built rentals skyrocket while those same immigration rates are down. Yeah, all this and more with a good friend and mortgage broker, Mr. Dion Begg, right after this. Here we are, my friends, back with our favorite mortgage broker and all of the land, Mr. Dion Begg. How you doing, my man?
Hey, Gary, really good. I got some interesting conversations and stories to share with you this week.
Excellent. That's what our listeners love. Interesting thing we did last week. We talked about all sorts of different things, the different strategies and mortgage strategies and asking the right questions or perhaps knowing what to ask. And one of the things that we talked about, Dion, is the fact that we're seeing a number of relist homes, 17,000 relist homes on the Toronto market. And I got lots of questions about that. It was kind of a crazy moment in the market, and we're still seeing some of that. And of course, as we get crazy numbers, and it is crazy numbers, we haven't seen anything like that in the past, Dion. There's lots of things happening in the market, and one of the economists that you and I like listening to or reading because it's very insightful is Ben Robideau of Edge Realty, and he provides a monthly report. We're going to go through some of that info today, Dion, and it's not to say it's going to be devastating one way or the other, but it really reveals some interesting facts about previous government decisions to what is happening right now. You know what I mean?
You got it. Yeah. And I mean, sometimes it's like in the market, you and I on the ground, we feel it, but having statistics to actually draw a straight line to what we're feeling is really good. So yeah, let's take a quick look at those.
Well, I like it. And straight line in a sense that it helps narrate the storyline of what, the information we need to share with clients, the information that perhaps you as a realtor or mortgage broker watching this need to share. And if you are an end user, which we all are, we need to understand this at some point. We don't have that, economic degree, but we have to know where to get that type of information. And it's pretty interesting. So as I said, he puts out this report monthly, and this is just some of the information coming out of it. And one of the interesting things here, Dion, over the last couple of years, and we've kind of been seeing this is housing starts in Canada. And you can see that orange line is purpose-built rentals, which, as we all know, we haven't had a big boom of purpose-built rentals since, the 60s, as it were, and a little bit into the 70s, then it kind of tailed off. And you can see that orange line in about 2023, we'll say, surpassed purpose-built condos and single-family homes. When you see something like this, what does that tell you?
Well, so many things here. So firstly, the gray line condos just fell off a cliff in 2024. But what this means is builders decided to stop building condominiums. This line, again, has a sharp drop at the start of 2024. But what you got to also understand is that the decision for that to happen was made many, many months before, right? Because they're still constructing other half-completed projects in the years 21, 22, 23. But what happened in that 3-year period is that the market turned, interest rates went insane, and investors disappeared. And they are the core buyer of those condos. So if you're a builder and your core buyer has decided that interest rates have made it such that the economics of buying an investment condo no longer makes sense, but you're a builder who has hundreds or maybe thousands of people on staff who are already constructing property, some of those buildings that were already slated to be condos were actually flipped over to apartment buildings to be continued to be owned by that builder as a long-term cash flow asset rather than an asset that they would sell and make some quick cash on. They're now holding them as long-term assets. But the other interesting thing is, again, if I put myself in the shoes of those builders were making those decisions to own these long-term rental assets under the previous government, who had made it abundantly clear that their immigration policy was to continue to allow these large numbers of immigrants to come into Canada over the next so many years up until the year 2030. And obviously, we had a change in sentiment in the country. We have had a change of government or government leader, and there's been a huge change to that policy. So the crazy thing now, Gary, is those poor builders, if we can call them that, those poor builders who now lost out on the condos, they're going to go build these rental buildings. But the question is, will there be anybody in the country to rent them?
Well, that's a good question. And of course, we have some data to look at with the immigration numbers. And before I flip to that screen, Dion, this is the other interesting piece here. And we've all talked about this. We've all had some sort of experience with this, whether you're a tenant or a landlord. And we all know in BC and in Ontario, where, two of the most populous areas in Canada, it is like sandpaper. The landlord-tenant board in both of those regions it can be a lot better and needs to be a lot better. And we've all heard the horror stories on both sides. And it's an interesting piece here. And I just wonder, I know we're not going to see dramatic change, but I wonder if we just see some more lobbying from those builders or large investment corporations that are now going to be holding these rental properties, put a little bit more pressure on the local governments to better that policy. I just kind of think out loud on that one. I just wonder what that looks like. And that's not a short-term conversation. That's a long-term conversation again.
It's a really big question. And I mean, if we look at it really simply, private landlords who own rental property are somewhat doing the government's job in terms of providing housing for people who can't afford to buy their own house, right? And so I think you are right, and it's been true for many years, that the landlord-tenant board is slanted mostly in favor of the tenant, which makes it less and less attractive as a property owner or investor to become that landlord. So if the government is wanting for private investors to continue to be those providers of housing, then yeah, they should probably take a look at how they view landlords and tenants in that balance there.
Yeah. And we don't want to go down that rabbit hole, but we know it needs to be better. We'll just leave it at that, and we can do a whole other call on how it needs to be better or why it needs to be better. You brought up an interesting point here as the purpose-built rentals are going up here. Will there be anybody to live in those homes? Well, on one hand, you can always say yes. However, we've got some data. We've got some data here that I'm going to share with you. It might not look as promising from that perspective as we thought here. And let me just make the screen bigger, Dion, so we can have a good look at it. And what we're looking at here is the population, or the annual population growth. And we got a couple of different colors, the blue being net permanent. So people that are coming here to stay, in a sense, the net non-permanent. So, student visas, short-term work visas, and then the gray is the natural increase. And that was something that you picked up on. As we kind of see, we saw a nice average over the last few decades. And then we all experienced what happened just after the COVID numbers skyrocketed. Now, focus in on what you saw when you first saw this image here.
Yeah, so if we go to the far left, that is 1980, what you see there in terms of the source of population growth, about 60 to 70% of the source of that growth came from natural increase, which is people having children, okay? And that was back when probably people had 2 to 3 children per household in 1980. And then as the years go on, especially in the 2000s, you can see that the proportion of that population growth that is represented by that small gray number there, as from natural births, is diminished to maybe 10 to 15%. And then in 2019 onwards, you can't even see it, meaning that the growth in our population has mostly come from immigration, really. Right, that's what that blue and yellow represent. So, the blue being buyers and the orange being renters. Now, as we jump over to 2025, which is, I guess, Q1, Q2 there, Gary, we're seeing not just a stop in increase, but an active decrease in the number of orange renters who are in this country, meaning, number one, we've effectively turned off the tap to immigration. And number two, the immigrants who are in the country are choosing to leave the country to the tune of 200 to 400,000 people. Okay, so this is an absolute 180 degree turn from where we were just 2 years ago, right? It's very dramatic.
Well, and to that point, I got some numbers here. The population growth flatlines as this report indicates. This is mind blowing in a sense, and we can see it right here on the screen. Canada's Q1 population growth was basically zero, the lowest it's been in 75 years.
Wow, that's crazy. Yeah.
Many Canadians have been asking for that. So, it's that balance effect that we're going to be walking over the next, probably over the next year or so, and finding that nice balanced approach. Because every country should have some sort of immigration and net growth from immigration, in my belief. Obviously, the last several years, it got way out of proportion, and we got to find that nice natural balance. As you can see, I think most would all agree over the last couple of decades, it wasn't a decent, balanced growth, population growth over the last several decades. This is the interesting piece, because this is kind of the exact opposite of the slide we just saw on purpose-built rentals. We need them. We got to build more. And yet we're seeing some data, real life data right in front of us as it plays out, with the number of potential renters declining over the last quarter and foreseeable future too. So that'll be interesting on how all those purpose-built rentals attract renters.
Yeah, Gary, let me just jump in here and just share my personal experience as an immigrant to Canada for some context for the people listening, right? So I moved to Canada 2008. At that time, Canada's population was a little over 30 million. And in the year that I moved to Canada, about 300,000 people moved to Canada, okay? So that was 0.1% of the population, okay? It grew by. And that was the case for many years. And, that immigration was supplementing the decrease in birth rate and the increase in GDP, and it was balanced. And I think you used that keyword earlier, balance. Now, when we look at the last 3 years, when we see about 1 million people per year on average for 3 years, look, immigration is good, but there's a thing called, too much of a good thing. And this immigration was basically not supported by GDP and housing, which has caused the issue that we are all finding ourselves in right now. And so, yes, we've got to get back to some level of balance. But when the pendulum has swung so far, where we've let this many people in, it probably does need to swing in the other direction. And there will be the subsequent pain in different sectors of the economy that happen when these drastic changes happen. The hope is that we after a little bit of balancing out, call it 3 to 4 years maybe, we get back to a happy medium and we hope that one government or the next doesn't push that pendulum so hard that things get crazily out of balance like they were in the last couple of years and will be in the next couple of years.
Yeah, that's well said. Well said. And the interesting thing here too is, as we talk about that balance and that pendulum, if I bring up that next slide here, Dion, this is what we're talking about in clear as day, meaning that we're seeing some minus net growth, if you will, over the last quarter, and presumably over the next couple of quarters too, as that pendulum goes one way to the other. The physics of a pendulum, it has a tremendous amount of speed as it starts gaining and going towards that middle, if you will, right? And it needs to kind of like swing back and forth a little bit. It'll be interesting to see what happens as this Liberal government tries to make the right changes that they see and that they feel that the Canadians feel that they deserve. So we'll watch this obviously with tremendous amount of interest, because this is not something you fix overnight, as we all know, and with all the other geopolitical things that are happening around the world right now, this is definitely interesting times. Here's something interesting too, Dion, and I don't have slides for this, but here's some interesting information. We talked about mortgage shifts. And of course, you and I have talked about the past with interest rates coming down. A lot of people are taking the 5-year terms and taking some, not landing so much as they did in the past, maybe on the 5-year fix, but taking some variable rates. And one of the other things too that is most interesting, and I asked you this off the call, CMHC changed some of their guidelines and increased the amount of mortgage or the purchase price of a home you can insure up to $1.5 million.
Yes, right.
And this report is saying that has not even made a dent into what people are borrowing, meaning only 2% of insured mortgages exceed $1 million. Is that your experience as well?
Yeah, so I have arranged a couple of mortgages this year that were insured mortgages where the borrower needed to borrow more than $1 million and less than $1.5 million. So I have arranged them, but they are truly the exception. They're not the rule. And, there's a couple of reasons for that. Number one, by the time you go to that kind of purchase price, it's usually because you've already owned a property. And when you're transitioning up to that next property, you usually have more than 20% down on that next purchase, right? So that's probably a big reason why people aren't choosing to use the CMHC insured, because they just don't need it, okay? But secondly, for these transactions to happen, real estate is somewhat like a traffic jam effect, meaning if the people at the top need to go from this house into their bigger home, somebody needs to buy their first home. And there are fewer and fewer transactions happening for that first home, which allows that second transaction to become a possibility. So there were probably two of the big reasons as to why, we're not seeing as much, but mostly it's the fact that people have 20% down at that price point.
Yeah, well, that's a good segue into the second story that in fact we talked about that you want to share. The first story being, as we set it up, the first story being, and we'll get to it, is I own a home today and I want to keep that as a rental. How do I go buy my next primary residence? So we'll get to that in a moment. But talk to us about why it's so important to have these conversations from You own a home and maybe you want to restructure some debt, looking forward and have that foresight into what type of questions and conversations people should be having with their mortgage broker, Dion. Because this is an important one. Because in the moment, it might seem like the right thing to do. However, that's not always the case, is it?
Yeah, that's right. So I'll give you an example of a young couple. They've got 2 young kids, and I met with them in November. So we're talking about 8 months ago. And at that time, we were refinancing their principal residence. Now, like many people, that accumulated a little bit of outside consumer credit cards, car loans, those types of things. And the goal was to consolidate everything into one manageable payment at much lower interest rates. But we also have a conversation about future plans and making sure they can manage payments long term. Now, my job as a mortgage advisor is to show people, look, here are your options, 1, 2, 3. And of these 3, I think number 2 might be the option for you based on your circumstance, okay? Now, our job is to present them, maybe give some advice, but at the end of the day, we are not the decision maker. The client is the decision maker. My advice to these particular clients was, as keen as they were to consolidate and then pay off their mortgage or debt as quickly as possible, by committing to a 20-year amortization, their payment, using round numbers, was going to be about $3,000 a month. Versus if they were to take a 30-year amortization, that payment was going to be closer to $2,000 a month. So it was about $1,000 a month differential in monthly payment. And I said to them, look, I understand that you believe you can commit to this $3,000 a month payment, but why don't you consider taking the $2,000 a month payment, which still will allow you to pay $3,000 a month, an extra $1,000 a month, if you wish, but it does not commit you to paying that higher payment every month. And I know they went away for a day or two and they came back and they said, Dion, we've had some deep conversations and we are willing to commit to this 20-year amortization with a $3,000 payment. And I said, okay, you've obviously given it some consideration, so we'll put that in place for you. Now, sadly, 8 months later, they are calling me saying, Dion, we were overly ambitious. We need to refinance and break this mortgage and take that 30-year amortization that I'd originally recommended, because as much as they thought they could pay that $3,000 a month. That $2,000 a month number is actually the number that they really want to get. And I'll say this to anybody: like, elimination of debt should be a goal, but it shouldn't come at the expense of you being able to live your life, right? And so, and there are still ways that you can be disciplined without the bank forcing you to this payment every single month. And those are the conversations that I think people need to have and be realistic about. I would much rather commit you to a payment that is too low than a payment that is too high. Because once it's set, it is set. Once it's too low, you can dial it up by your own choice using your prepayment allowances. So some food for thought for people who have sort of said, committing to themselves, we're going to get rid of this debt. Just don't overcommit. That's a big message.
And the prepayment privileges, just about every mortgage product out there has some sort of form of it. And it could be anywhere from 10% of your original balance to maybe 20%. Does that help us guide us a little bit on that, what that looks like?
Yep. So on a $500K mortgage, at the very worst, you're going to get a 5% prepayment, which is $25,000 a year on top of your regular payment, all the way up to 20% a year, which is $100,000 a year extra on top of your regular payment. And so whichever mortgage you get, and it's not every single one, so be careful, because some lenders who have super low interest rates do not allow for generous prepayments. But almost every mortgage that we arrange comes with a 10 to 20% prepayment.
Excellent. Okay, so the other scenario or question, story, real life example that you had this past week is a client coming in, and we've all had these conversations with our clients. I own my townhouse. I own this house. I live in it. It's my primary residence, and we need to move up. However, I understand the value of real estate. I want to be able to keep this. Is there a world where this is possible? And usually there is, but you have to have the right conversations, right?
You got it. So I just had a client call. Client's name is James. James owns a townhouse in Pickering worth around $600,000. And he's at the point where the family's growing and he wants to go and buy that $1 million detached house. Okay. So James called me and said, Dion, I don't have a mortgage on my first home, but I want to keep it and I want to buy that $1 million home. Is this possible? And he'd spoken to somebody at his bank who wasn't able to give him a clear answer. So in that 10-minute phone call with him, I said, here's what's possible. First, we go and access around $300,000 from the existing townhouse. That $300,000 would be more than enough for 20% down on the new purchase, plus land transfer tax, plus a little bit of a buffer for furniture and other things. Okay. So step number one, refinance the townhouse, get access to, say, $300K. Step number two, use some of that $200,000 actually as down payment on a $1 million purchase, securing that $800,000 mortgage on the new $1 million home. Now, his question was, Dion, am I going to be able to still afford this next property if I'm taking a $300K mortgage out on my existing property, which he very proudly had just paid off, and the thought of going back into debt sort of was counterintuitive. But I explained to him this. I said, look, that payment on that $300,000 is going to be about $1,500 a month. The rent you're going to get on your townhouse when you move out is about $2,500 a month. And the way the banks look at this is, look, if the $2,500 is greater than the $1,500, then it neutralizes that payment somewhat. It doesn't work exactly like this, but roughly. It neutralizes that payment. So the debt that he just got on his townhouse does not have a negative impact on his ability to go and buy that next house, which will require an $800,000 mortgage. So on that call, he got super excited that, something that he thought wasn't possible is possible. And now we are in the process of refinancing him and then helping him set up for his purchase.
I love it. And I already know where a lot of listeners went. They tuned out when you said your client there owned his property, the townhouse, without a mortgage. Yeah, right. If you listen to the story, there at the end of the day, there was a mortgage on that property. So I know many of our listeners are in that same situation where, in this case, I think you brought that up to approximately 50% loan to value. And I'm sure many of our listeners can relate to that, right? So don't get caught up on the fact that, hey, this home was already paid for. At the end of the day, they use the leverage of that equity
Yeah.
to go buy the other house, right?
Yeah. Many people, myself included, have used this strategy when the first house still had a mortgage. But behind the existing mortgage, we can still create more access to other equity, which we can use for the next.
Yeah, yeah. And the other key factor here, my friends, I know a lot of you have already picked up on it, is you access $300,000 for $1 million purchase, yet you earmarked, if you will, 200,000. Why is 200,000 important? You had a minimum of 20% down, which kept you out of CMHC financing, all those other fun extra fees, right?
Yeah, yeah. And actually, oftentimes people call me and say, Dion, I'm going to put down this certain dollar amount. And I see how close they are to 20%. And I say, look, let's figure out a way to get to 20%, save you 30, 40 grand in CMHC insurance. And in many cases, we can get that done. And again, it sort of links back to what you said earlier about why aren't people utilizing CMHC insurance above $1 million? It's because they really don't have to in most cases.
Yeah, there you have it, my friends. So I know many of you have these same types of questions for Dion. How do people get a hold of you?
Yeah, you can reach me at kangamortgage.ca or Instagram at @TheDionBeg.
There you have it, my friends. That's Dion Begg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.